Most people know that stocks and bonds are both types of investments, but do you really understand how they work, how they generate income, and what risks they carry? In this video, we'll explore what really separates stocks from bonds. We'll begin with simple explanations and examples, then dig deeper, and finally end up with a comparison that'll help you understand the main differences. Hey there, this is Powerful Entrepreneur, where investing concepts are explained in a simple way. Before we dive in, a quick disclaimer. This content is for educational purposes only and is not financial advice. Now let's get into it. What is a stock? A stock, also known as equity, represents ownership in a company. When you buy a stock, you become a shareholder. That means you own a small part of that business, a slice of its profits, its assets, and even its decision-making if you hold voting shares. Stocks generate income in two main ways. Capital gains. If the company performs well, the stock price may increase. You can then sell it for more than you paid. Dividends. Some companies return a portion of their profits to shareholders in the form of regular cash payments. However, not all companies pay dividends. Fast-growing companies often reinvest profits to fuel further growth instead of paying out dividends. Stock prices are influenced by many factors: company performance and profitability, industry trends. For example, technology is the actual trend, economic conditions, such as a growing period or a recession, and investor expectations. Because of this, stock prices can fluctuate significantly, sometimes within minutes. This volatility is one of the defining features of stocks. Let's take an example. Imagine Sarah, a 25-year-old graphic designer. She buys $2,000 worth of stock in a tech company she believes in. A year later, the company launches a hit, a new product, and the stock price jumps 40%. Sarah sells her shares and walks away with an $800 profit. But it's not always that simple. The same stock could also drop 30% if the company underperforms or if the broader market experiences a downer. This is why stocks carry more risk, especially in the short term. In this channel, I've uploaded several videos explaining metrics like the P/E ratio, EPS, and enterprise value, which can help you evaluate stocks before buying. So make sure to subscribe if you're serious about learning. Now that we know what a stock is, let's explain the bonds, a completely different kind of investment. A bond is a debt instrument. When you buy a bond, you're essentially lending money to the issuer. This issuer could be a government, a corporation, or even a municipality. In return, the issuer promises two things: to pay you interest at regular intervals, called coupon payments, and to return your full initial investment at a future date, called the maturity date. These two concepts are very important when investing in bonds: the coupon payments and the maturity date. Let's use a simple example. You buy a bond for $1,000 with a 5% annual interest rate. That means you receive $50 every year as interest. After, say, 10 years, the bond matures, and you get your $1,000 back added to the coupon payments. So far, so good. But here's where it gets interesting and a bit more complex. The price of a bond in the open market can change, even if the interest payments stay fixed. Why? Because of interest rates. Let's continue with the 5% bond that pays $50 annually. Now imagine interest rates rise to 6% in the market. New bonds are being issued that pay $60 a year instead of $50. Compared to those, your bond is less attractive. It offers a lower return for the same $1,000. To stay competitive, the price of your bond must drop. This price drop increases its effective yield to match the new market rate. On the flip side, if interest rates fall to 4%, your 5% bond looks more appealing. New bonds are only offering $40, but yours still pays $50. Investors may be willing to pay more than $1,000 for that bond now. So the relationship is simple but powerful. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This can be explained mathematically using the bond pricing formula. C is the coupon payment, the fixed amount of interest the bond pays each period. R is the interest rate or discount rate. This reflects current market rates and is used to calculate the present value of future payments. F is the face value, the amount the bondholder will receive when the bond matures. N is the number of periods remaining until the bond reaches maturity. As increases, the denominator in each term becomes larger, reducing the present value of each future payment and thus the bond's price. However, bonds aren't risk-free. Here are the three main types of risk. Credit risk, because the issuer might default and fail to pay you back. Interest rate risk, that could affect to the value of your bond if interest rates change. Inflation risk, given that the interest you earn might not keep up with rising prices, reducing your real purchasing power. Now, let's create a comparison between these two types of assets. Ownership. When you buy a stock, you actually become a partial owner. With bonds, you're not buying any ownership. Income source. Stocks can provide income through dividends or capital gains. Bonds offer coupon payments, and if you sell your bond before its maturity date, you might receive a price that is either higher or lower than what you originally paid, depending on market conditions. Risk level. Stocks tend to carry a higher level of risk. Bonds are generally seen as lower risk investments, though they're not risk-free, depending on the type. Return potential. Over the long term, stocks typically offer a higher potential return. Bonds usually offer lower returns. Use in a portfolio. Stocks are often used for growth. Bonds are typically used to add stability and generate income. In the real world, most investors use a mix of both. This is called diversification. Younger investors tend to focus on stocks because they have time to recover from market swings and aim for long-term growth. Older or more conservative investors may lean more toward bonds for steady income and lower volatility. Here's an example. Mark is 30 years old and planning for retirement. His portfolio is 80% stocks and 20% bonds. He's willing to take risks now to grow his wealth. Meanwhile, Jane is 60 and preparing to retire in 5 years. She's 30% in stocks and 70% in bonds, focusing on income and capital preservation. This balance, often called asset allocation, is a fundamental part of building a smart investment strategy that matches your goals and risk tolerance. Thanks for watching. If you found this helpful, hit the like button, subscribe, and ring that notification bell so you don't miss future videos. And if you want to go deeper into either of these, you can check out this video as well. See you next time on Powerful Entrepreneur.